It can be very confusing when it comes to investing because there are lots of investment vehicles out there. In today's video, I am going to explain the most common investment vehicles in a simple way, so you will have a solid foundation. After watching this video, you will understand the different types of investments and be able to decide which type is the right choice for you. So, let's dive in. Investment vehicles are various financial instruments or tools that individuals, businesses, and institutions use to invest their money and potentially generate returns. These vehicles offer different levels of risk, potential returns, and liquidity, allowing investors to tailor their investment strategies based on their goals and risk tolerance. Here are the investment vehicles you will learn today. Stocks, also known as equities, represent ownership shares in a company. When you own stocks of a company, you are essentially buying a piece of that company and becoming a shareholder. Investing in stocks involves both potential rewards and risks. As a shareholder, you have the potential to benefit from the company's growth and profitability through capital appreciation and possibly dividends. However, the value of stocks can also fluctuate, and there's a risk of losing money if the company's performance declines. Stocks are bought and sold on stock exchanges. Stocks are generally considered liquid investments because they can be easily bought and sold on stock exchanges. Stocks are often considered a long-term investment, as their value can be influenced by market conditions and the company's performance over time. Holding stocks for an extended period allows you to potentially ride out market volatility. Before investing in stocks, it's important to conduct thorough research and analysis. Understanding the company's financial health, competitive position, industry trends, and management team can help you make informed investment decisions. Bonds, also known as fixed income securities, are debt instruments issued by governments, municipalities, or corporations to raise capital. When you buy a bond, you are essentially lending money to the issuer in exchange for periodic interest payments and the return of the principal amount at maturity. Bonds can have short-term, intermediate-term, or long-term maturities. Bondholders receive periodic interest payments, typically semi-annually or annually. These payments provide a steady income stream to investors. Bonds are generally considered lower-risk investments compared to stocks because they provide regular income and the return of the principal at maturity. However, there is still risk involved, especially if the issuer defaults on interest payments or fails to repay the principal. Exchange-traded funds, ETFs. These are the investment funds that are traded on stock exchanges, similar to individual stocks. They offer investors exposure to a diversified portfolio of assets, such as stocks, bonds, commodities, or other financial instruments. ETFs have gained popularity due to their flexibility, diversification benefits, and cost efficiency. ETFs provide instant diversification because they hold a basket of different securities. For example, an ETF tracking a stock market index might hold shares from hundreds or thousands of companies, spreading risk across the entire index. ETFs often disclose their holdings daily, allowing investors to know exactly what assets the fund holds. This transparency is beneficial for understanding the fund's composition and potential risks. There are two main types of ETFs, passive and active. Passive ETFs aim to replicate the performance of a specific index and have lower management fees. Active ETFs, on the other hand, are managed by professionals who actively select and manage the fund's holdings with the goal of outperforming the market. ETFs provide access to a wide range of asset classes and investment strategies that might be otherwise difficult for individual investors to access directly. Real estate. Real estate is a tangible and physical investment class that involves purchasing, owning, and managing properties for the purpose of generating income and potential capital appreciation. Real estate can include various types of properties, such as residential, commercial, industrial, and even land. One of the primary ways real estate investors earn returns is through rental income. Investors purchase properties and lease them to tenants, receiving regular rent payments. Real estate properties can appreciate in value over time due to factors such as location, market demand, infrastructure development, and economic growth. Capital appreciation can result in potential gains when the property is sold. Real estate investments often allow for leverage, meaning investors can use mortgages to finance a portion of the property's purchase price. This can amplify returns if the property appreciates, but it also adds risk. Real estate investors can benefit from various tax advantages, including deductions for mortgage interest, property taxes, and depreciation. Real estate is often considered a long-term investment strategy due to the illiquid nature of property transactions and the potential for value appreciation over time. Commodities. Commodities are raw materials or primary agricultural products that are traded in standardized forms on commodity exchanges. They are the building blocks of many products and play a crucial role in the global economy. Commodities can be broadly categorized into several groups such as agricultural commodities, wheat, corn, cotton, and coffee. Energy commodities, crude oil, natural gas, and gasoline. Precious metals, gold, silver, and platinum. Industrial metals, copper, aluminum, and iron. Investing in commodities can provide portfolio diversification and act as a hedge against inflation. However, it's important to note that commodity prices can be volatile due to various factors such as supply and demand imbalances, geopolitical events, weather conditions, and changes in global economic trends. Options and derivatives. Options and derivatives are financial instruments that derive their value from an underlying asset, such as stocks, bonds, commodities. They are widely used for hedging, speculation, and risk management. Options are contracts that give the holder the right, but not the obligation, to buy or sell a specific underlying asset at a predetermined price within a specified time frame. There are two main types of options. First one is called call option, which gives the holder the right to buy the underlying asset at the predetermined price before or on the expiration date. Call options are often used by investors who anticipate an increase in the price of the underlying asset. The other one is put option. Put options give the holder the right to sell the underlying asset at the strike price before or on the expiration date. Put options are often used by investors who anticipate a decrease in the price of the underlying asset. Let's look at the derivatives. A derivative is a financial security that is set between two or more parties. Traders use derivatives to access specific markets and trade different assets. They are used for managing risk, speculating on price movements, and gaining exposure to various market factors. Common derivatives include futures contracts, forwards, options, and swaps. Derivatives can be complex and require a deep understanding of the underlying assets and market dynamics. They offer flexibility and risk management capabilities but also involve the potential for substantial losses if not used correctly. Both options and derivatives are commonly used by institutional investors, fund managers, and individual traders for various purposes, including managing risk exposure, speculating on price movements, and enhancing investment strategies. Annuities. Annuities are financial products that provide a stream of income over a specified period, often for the rest of the annuitant's life. They are typically offered by insurance companies and are designed to offer financial security and help individuals manage their retirement income. There are two types of annuities. With an immediate annuity, you make a lump sum payment to the insurance company and in return, you start receiving regular payments immediately. These payments can be fixed or variable and can last for a specified period or for life. Deferred annuities are purchased with either a lump sum payment or a series of payments. However, the annuity payments begin at a future date, allowing the invested funds to grow over time before you start receiving income. Annuities can be suitable for individuals who want a guaranteed stream of income in retirement, have maximized other retirement savings options, and are concerned about outliving their savings. However, it's important to carefully evaluate the terms, costs, and potential benefits of an annuity, as well as how it fits into your overall financial plan. Cryptocurrencies. Cryptocurrencies are digital or virtual currencies that use cryptography for secure transactions and control the creation of new units. Cryptocurrencies have gained significant attention for their potential to revolutionize various industries and financial systems. Most cryptocurrencies utilize blockchain technology, a distributed and transparent ledger that records all transactions in a secure and unalterable manner. This technology ensures transparency and prevents double spending. Investing in cryptocurrencies can offer significant opportunities, but it also comes with various risks that investors should be aware of. Cryptocurrency markets are known for their extreme price volatility. Prices can experience rapid and substantial fluctuations over short periods, leading to potential gains but also significant losses. Cryptocurrencies have the potential to reshape industries, disrupt traditional financial systems, and enable new forms of decentralized applications. However, due to their complexity and risk profile, you should approach cryptocurrency investment with caution. In the world of finance and investment, a diverse range of opportunities awaits those seeking to grow their wealth and secure their financial futures. Today, we've explored some of the key investment vehicles that empower you to achieve your financial goals. From the dynamic realm of stocks and the stability of bonds to the flexibility of exchange-traded funds, ETFs, the tangible nature of real estate, and the potential of commodities, there's an investment avenue suited to every risk appetite and objective. In this ever-evolving landscape, remember that investment decisions should be approached with patience and a long-term perspective. Markets may rise and fall, but a well-informed and disciplined approach can help you weather challenges and capitalize on opportunities.